If you're generating revenue from AI systems and automated platforms, understanding how current IRS reporting frameworks apply to this income is becoming increasingly important. As regulatory guidance continues to evolve, clarity around classification and reporting is expected to expand. Hi, I'm Mr. Bones. Today we're examining a critical disconnect. Your AI agents generate revenue, but your 1099 forms show zeros. This regulatory gap is being closed by the IRS in 2026. So let's begin. Your automated systems generate revenue around the clock. Your AI-assisted tools execute tasks, and your digital assets produce value. This income is legitimate, global, and reflects real economic activity. However, under the current tax reporting framework, this emerging category of revenue faces significant classification challenges. Examine your financial dashboard alongside your official tax documents. You may notice a discrepancy. Revenue streams from automated and AI-assisted activities may not be clearly reflected on standard information returns, like the 1099 series. This presents a compliance consideration that requires proactive attention. For professionals with sophisticated income streams, this situation represents an evolving regulatory landscape, not an opportunity for non-compliance. The current lack of clear reporting guidelines creates a planning challenge that demands strategic foresight. I'm Mr. Bones, and today we're analyzing this evolving landscape to understand the 2026 regulatory horizon. Let's review the current environment. Many professionals utilize platforms that provide computational resources or AI services. You deploy your systems, the platforms provide infrastructure, and value is created. The financial exchange is clear. However, the reporting pathway is less clear. These technology platforms typically define themselves as service providers. Their agreements state that users maintain responsibility for tax compliance. They generally do not issue information returns for what they classify as service fees, rather than payments for goods or traditional services. The Internal Revenue Code's existing categories for income reporting were established before these modern digital activities became prevalent. Determining whether this revenue constitutes ordinary business income, royalties, or falls into another classification requires careful analysis. Without clear classification, standardized third-party reporting mechanisms often don't trigger. Historical context provides valuable perspective. Consider the evolution of digital asset reporting. In the early years of cryptocurrency, transactions occurred without standardized information reporting. The regulatory approach evolved through official guidance, such as the 2014 notice classifying virtual currency as property. This established a framework that later evolved into specific reporting requirements, including checkboxes on tax forms, and eventually, comprehensive legislation like the Infrastructure Investment and Jobs Act provisions. This evolution from new technology to integrated reporting followed a measurable timeline. Income from AI-assisted and automated systems today exists in a similar pre-codification phase. The pattern of technological innovation followed by regulatory adaptation is well established. We are in a period where regulatory bodies are actively studying these new economic activities. This brings us to the 2025 to 2026 period. Several official documents indicate the direction of regulatory development. The IRS Strategic Operating Plan for fiscal years 2025 to 2027 includes initiatives to enhance third-party information reporting, specifically noting the need to address evolving types of income. Automated digital revenue falls precisely into this category of evolving income. Additionally, Treasury Department publications have discussed potential modifications to information reporting thresholds for certain digital transactions. The current framework generally requires reporting at a $600 threshold per payer. Proposed concepts have included considering aggregate transactions across similar platforms. Consider this operational perspective. Multiple specialized digital tools generating smaller revenue amounts across different platforms might not individually trigger current reporting thresholds. Changes to aggregation rules could alter this reporting calculus, potentially creating new information reporting obligations for platforms. These are not speculative concepts, but matters of public administrative discussion found in official government publications. 2025 represents a period for observation and commentary. with potential implementation phases targeted for 2026 and beyond. Understanding this trajectory is essential. The complementary action is preparation. Here are general principles that high-income professionals might discuss with their legal and tax advisors. These are conceptual frameworks, not specific advice. Documentation principle. Implement consistent record keeping for all digitally generated revenue streams. Key data points include date and time of transaction, the specific tool or system involved, the platform or counterparty, transaction identifiers, and amounts. Comprehensive documentation creates a verifiable record of economic activity. Classification principle. Consult with qualified professionals to develop a consistent, supportable position regarding the nature of this income. Different classifications, business income, royalties, etc., have different implications for deductions and reporting. The critical factor is establishing a reasonable documented position and applying it consistently. Structural principle. For substantial automated revenue streams, operational separation through appropriate business entities can provide clarity. This isn't about concealment, but about creating transparent operational boundaries. Separate accounting and legal structures can simplify compliance management. Professional guidance principle. The intersection of advanced technology and complex tax law requires specialized expertise. Engaging professionals who understand both domains is a prudent investment. Proactive consultation allows for strategic planning rather than reactive problem solving. Consider the operational impact of delayed preparation. If regulatory changes implement new reporting requirements, reconstructing historical financial data from incomplete records or deprecated systems becomes significantly more complex and costly. Proactive organization transforms potential compliance challenges into manageable administrative processes. The regulatory approach to digital and automated income will continue to develop. The strategic question is about timing and preparation. The objective isn't circumvention, but engagement with the regulatory system from a position of clarity and organization. Strength in compliance comes from meticulous documentation, professional guidance, and treating regulatory planning with the same systematic approach applied to business operations. Recommended actions for consideration. Review and organize records of all automated and digital revenue streams. Schedule a consultation with qualified tax and legal professionals to discuss your specific situation. Develop systematic processes for ongoing documentation and classification. The nature of work continues to evolve with technology. A sophisticated approach to compliance should evolve correspondingly, emphasizing anticipation and organization. In future discussions, we will examine how changing definitions of residency and physical presence create new considerations for professionals with location-independent workflows. Until then, I am Mr. Bones. Focus on understanding regulatory trends, maintain meticulous records, and seek qualified professional guidance for your specific circumstances.